Why IVR is garbage. David Jaffe with BestStockStrategy.com, and in this video we are going to learn why you should not use IVR. IVR is implied volatility rank. It has been made popular by Tastyworks and Tom Sosnoff and Tony Batista. What IVR does is it measures the high and the low of the implied volatility of a specific underlying over the past 12 months and then states it as a percentage relative to its highs and lows. Again, just to be clear, what IVR does is it looks at the current implied volatility and then it compares it to the high of the implied volatility and the low of the implied volatility, and then it spits out a percentage of where the current implied volatility ranks relative to the high volatility and the low implied volatility of a specific underlying over the past year. So you would think that if a specific underlying currently has relatively high implied volatility rank, which would be something over about 50 or 60%, then it would be a good opportunity for you to sell premium in that security because the implied volatility of that specific security is high relative to what it normally is. The problem with implied volatility rank is that it is subject to extremes. So right now it is December 23rd, 2019. Just about a year ago, on December 24th, 2018, the S&P 500 was down around 80 points, and then it had about a 120 point reversal intraday. The reason why this is significant is that right now, at this specific moment, the December 24th reversal and the high point for the volatility is still factoring into the 1 year time period and the 1 year look back period. What this means is that the extremes are factored into and measured in the implied volatility rank equation. And as a result, the current IVRs for all of the stocks in your watch list are in all likelihood artificially low when compared with where they will be in just a few days once that December 24th, 2018 day actually falls off and implied volatility actually normalizes. Again, the real problem with IVR is that it leaves you subject to the extremes, both on the high end and the low end. So those people who scan their watch list for high IVR, what they're doing is they're comparing IV rank against a base number, the high point, where the IVR at that specific moment is not necessarily representative of current market conditions. And it's probably not representative during normalized markets. Because when you look back at December of 2018, that was a very high volatile environment where there was substantial fear in the marketplace. And I believe the S&P 500 lost close to around 20% in just 1 month. As a result, you need to be extremely careful when factoring in and using those high IV environments into your present day situation and into the present day environment. So those people who are scanning their watch list for high IVRs, their IV ranks are artificially deflated. What Tastyworks should do is they should look at the median implied volatility, and then they should compare that against the current volatility. So the equation, what it would look like is you would have the current implied volatility as the numerator. Then you would have the median implied volatility for that specific underlying as the denominator. That way, when you use the median as your denominator, you are not having the outlier moves in implied volatility factor into and influence your decision of whether you should make a trade in the present moment. So again, you would look at the current implied volatility as the numerator. Then as the denominator, you would have the median implied volatility over a specific time frame, whether it be 6 months or 12 months, that's fine. And then the higher that number is, the better. So that would be a much more useful indicator on whether a stock in your watch list is worthy of you trading it. David Jaffe with BestStockStrategy.com. If you have any questions, leave a comment below. I respond to everyone's comments.